used to go to a bank, but post-2008, banks are more cautious about exactly this kind of loan, mid-market, moderately leveraged, not enough collateral to feel clean on a stress test. So now you go to Apollo Global Management, or Blackstone, or Ares Management, or Blue Owl Capital. These are not banks. They are investment firms. Apollo alone manages over $500 billion in assets. Ares Credit manages over $300 billion. Blackstone's credit platform has grown by over 40% in the last 3 years alone. $500 billion. That number is wrong. Not wrong in the sense that I made it up, wrong in the sense that it's the conservative estimate. The number that doesn't make people's eyes glaze over. The number I used because if I put the real figure in the title, you'd have assumed it was clickbait and moved on. The real number is $1.7 trillion on screen. $7,100 billion. That is the size of an industry called private credit, a market that the IMF has formally flagged as a systemic risk, that the Bank of England has issued public warnings about, and that the Federal Reserve monitors with what can generously be described as quiet concern. It has no public pricing, no standardized disclosure, no stress tests, no deposit insurance. Your pension fund is almost certainly in it, and there's a reasonable chance that until about 45 seconds ago, you had never heard of it. The regulators have been writing reports about it since 2022. Very thorough reports, very well formatted ones. Let's talk about what those reports actually say. But first, let's start with the version of this story everyone already knows, because the part nobody talks about makes a lot more sense once you understand what we were all told to believe. Here's the version of this story that everyone already knows. In 2008, the global financial system collapsed because banks had spent years making reckless loans, packaging those loans into securities nobody understood, and hiding the risk in places regulators couldn't see. You know this. It became a movie. Multiple movies. There was even a celebrity cameo explaining synthetic CDOs using Jenga blocks, which tells you everything you need to know about how bad things got. So the response, and this part actually happened, this isn't spin, was serious. Basel III came in. Capital requirements went up. Banks had to hold more liquid assets against their riskiest positions. The Dodd-Frank Act created new oversight mechanisms. Stress tests became mandatory. Every major U.S. bank now has to demonstrate annually that it can survive a hypothetical severe recession without collapsing. And here's the thing, it worked. On screen, U.S. bank failure rate 2010, 2023 versus 2000, 2008. By every measurable standard, American banks are safer today than they were in 2006. Capital ratios are up. The average common equity tier 1 ratio for large U.S. banks sits around 13.5% today, compared to roughly 7% before the crisis. Leverage is down. Exotic off-balance sheet instruments that existed purely to move risk somewhere invisible dramatically curtailed. The FDIC logged over 500 U.S. bank failures between 2008 and 2012. In 2022, that number was 0. The system worked exactly as designed. Keep that phrase in mind, exactly as designed, because that's where the story gets complicated. Because risk doesn't just evaporate when you put a fence around it. It looks for the nearest gap in the fence. And in this case, the gap was enormous. $1.7 trillion enormous, and it had a very specific name. We'll get there. But first, here's something I want you to hold on to. Think of the financial system like water pressure in a pipe. Tighten one section of the pipe, put in the regulations, raise the requirements, clamp down, and the water doesn't stop flowing. It finds the path of least resistance, the unsupervised pipe, the one with no pressure gauges, the one nobody installed a flow meter on. We'll come back to that metaphor because it's going to do a lot of work in this video. If this is already making you uncomfortable, and we haven't even gotten to the bad part yet, hit subscribe because it's about to get a lot more specific. Private credit at its most basic is this: a loan made by someone who isn't a bank, or in plain English, you need to borrow $200 million for your mid-sized manufacturing company. You're too small for the public bond market, which has minimum sizes and disclosure requirements you don't want to deal with. You used to go to a bank, but post-2008, banks are more cautious about exactly this kind of loan, mid-market, moderately leveraged, not enough collateral to feel clean on a stress test. So now you go to Apollo Global Management, or Blackstone, or Ares Management, or Blue Owl Capital. These are not banks. They are investment firms, the same kind of firms that manage private equity buyouts and hedge fund strategies. But they have also built over the last 15 years massive lending operations that now rival traditional bank lending in scale. Apollo alone manages over $500 billion in assets. Ares Credit manages over $300 billion. Blackstone's credit platform has grown by over 40% in the last 3 years alone. These are not small operations moonlighting in lending. This is their primary business, and business is very, very good. Here's how the money flows. The private credit firm raises a fund. Investors in that fund, and we'll come back to who those investors are because it matters enormously: commit capital. The firm deploys that capital as direct loans to borrowers, typically mid-market companies. Those loans carry interest rates 2 to 4 percentage points higher than equivalent bank loans. The borrower pays more. The fund earns more. The firm collects its management fee, typically 1.5 to 2% of assets annually, plus a performance fee of around 20% of profits above a certain threshold. That structure is called 2 and 20. If it sounds familiar, it's because it's the same fee structure hedge funds use. On $1.7 trillion, let that number sit for a second. If private credit funds charge borrowers more, pay managers handsomely, and collect massive fees, where's the catch? We'll get there. But first, who are these investors? Because this is where it starts to get interesting. The typical investor in a private credit fund is what's called a qualified institutional buyer. Pension funds, endowments, sovereign wealth funds, insurance companies, the kind of entities that manage money on behalf of millions of ordinary people who will never read a private credit fund prospectus and wouldn't understand one if they did. But there's a second category of investor that's been growing fast, and it involves a 3-letter structure I told you to remember: business development company. A BDC is a publicly traded investment vehicle, meaning retail investors like you can buy shares in it that invests primarily in private credit loans. It was created by Congress in 1980 specifically to funnel capital into small and mid-sized businesses. Noble intention. The practical result in 2025 is that it allows private credit firms to raise money from ordinary retail investors, your brokerage account, your IRA, while operating with disclosure requirements far lighter than those that would apply to a bank doing the same thing. On screen, BDC structure diagram. According to the SEC, there are currently over 50 publicly registered BDCs with combined assets exceeding $300 billion. The fastest growing ones are managed by, you guessed it, Apollo, Blackstone, and Ares. So now you understand the machine. Here's who's operating it, who's feeding it, and who's quietly paying for it. Post-2008 banking regulation pushed risky lending out of supervised banks and into unsupervised private credit funds. Those funds raised money from pension funds and, increasingly, ordinary retail investors through BDC structures. They charge borrowers more, pay managers handsomely, and have grown from roughly $400 billion in 2010 to $1.7 trillion today. That's 4x in 14 years, while traditional bank commercial lending grew at less than half that rate. At the exact time bank lending to mid-market businesses tightened, down roughly 18% in real terms since 2010, private credit tripled. Those two lines are not a coincidence. They are causation. The regulation that made banks safer pushed the risks somewhere else, and private credit was standing there with a very large bucket. Now, here's the first moment where I have to give you the devil's advocate position. Isn't this just healthy market function? Banks got more conservative, a gap opened up, private lenders filled it. Isn't that how capital markets are supposed to work? And the answer is sort of, yes, in theory. Except the gap wasn't filled with a different kind of supervised lending. It was filled with lending that has almost no public reporting requirements, no standardized default tracking, no mandatory stress tests, and no deposit insurance backstop if something goes wrong. Or to put it another way, the risk didn't get managed differently. It got hidden differently. But it gets worse. Here's something the industry doesn't advertise. The biggest private credit firms don't just lend to companies. They lend to companies they also own. Apollo manages one of the world's largest private equity portfolios. It also runs one of the world's largest private credit operations. When an Apollo private equity fund buys a company and that company needs debt financing, who provides the loan? In many cases, another Apollo fund. This is called affiliated lending, and it is technically permitted. There are disclosure requirements. There are theoretical conflicts of interest policies. In practice, it means the same firm sits on both sides of the transaction, setting the loan terms, setting the interest rate, and collecting fees from both the lending fund and the equity fund simultaneously. For those keeping track, that's getting paid twice to do a deal with yourself. And the pension fund whose money is in both those funds, they get a quarterly report in PDF format, also very well formatted. But it gets worse. There's a mechanism in private credit called NAV financing. NAV stands for net asset value, basically, the paper value of the assets in a fund. Here's how it works. A private credit fund lends money to Company A. Company A is now an asset on the fund's books, valued at, let's say, $100 million. The fund can then use that $100 million paper valuation as collateral to borrow more money, which it lends out again, which creates more paper assets. assets, which can be used as collateral again. The critical detail, and hold on to this, is that the $100 million valuation of Company A is not set by a public market. There's no stock price. There's no daily auction. It's set by the fund manager, using a model they built that they are not required to have independently audited to any standardized public methodology. In plain English, they are marking their own homework, and the grade they give themselves determines how much more they can borrow, which determines how big the whole system gets. The IMF flagged this specific mechanism in its 2023 Global Financial Stability Report as a source of potential hidden leverage, which is the IMF's way of saying, we think the number is bigger than they're telling us, and we can't prove it because we can't see inside. If this is making your eye twitch, smash that like button because we haven't gotten to the pension fund number yet. Now, I want to address something directly because I know some of you are thinking it. These firms aren't doing anything illegal, and that's correct. Affiliated lending is disclosed technically. NAV financing is a recognized industry practice. Operating with lighter disclosure than banks is permitted under the Investment Company Act. None of this is criminal. To play devil's advocate more bluntly, maybe the complexity is just what sophisticated lending looks like at scale. Except here's the thing. The banks in 2006 weren't doing anything illegal either. The CDOs were legal. The structured investment vehicles were legal. The off-balance sheet arrangements were legal. Legal and safe are different words. The history of financial crises is almost entirely a history of legal things that turned out to be catastrophically dangerous once the market conditions changed. But it gets worse. Let's talk about the pension fund number I've been dangling. According to Prekin, pension funds and insurance companies have poured more than $400 billion into private credit strategies, chasing the 12 to 15% advertised annual returns that look extraordinary compared to the 7 to 8% you'd get in public markets. And to be fair, those returns have largely materialized. In the years since 2010, private credit has performed well. Default rates have been manageable. Investors have made money. This is the part where the industry would like you to stop the video. Here's the part they'd rather you didn't hear. Those returns exist partly because private credit has been operating in an almost uniquely favorable environment. Low interest rates, a growing economy, and the ability to set its own valuations. What hasn't been tested is what happens when rates stay high, when mid-market companies start struggling under 2 to 4% premium debt, and when the pension funds that own $400 billion in illiquid private credit assets need liquidity at the same time. We don't know, because it hasn't happened yet. We don't even know the true default rate in private credit right now, because these aren't publicly traded instruments, and firms are not required to report them uniformly, which is, to put it mildly, a problem. But anyway, let's talk about what happens when this market sneezes, because this is the part that stops being about Wall Street and starts being about you. But it gets worse, and this time, it's not abstract. Private credit doesn't just sit in a corner of the financial system. It is now the primary source of financing for mid-market companies, businesses with revenues between roughly $10 million and $1 billion. These companies, according to the National Center for the Middle Market, employ approximately 48 million Americans, nearly 1 in 3 private sector workers. These companies are now largely dependent on private credit because the bank alternative mostly disappeared after 2008. If private credit contracts sharply, whether from a rate spike, a major default chain, or a regulatory intervention, those companies don't have another place to go. Not quickly. Banks aren't set up to absorb the volume. The public bond market has minimum sizes they can't meet. A private credit freeze doesn't just hurt investors, it hits payroll. Now, here's where I'll give the industry its second devil's advocate moment. These firms are sophisticated. They've been through cycles. They have credit analysts, risk models, restructuring teams. They're not blindly deploying capital. And that's true, but sophistication is not the same as accuracy. The firms that built the 2006 CDO market were also sophisticated. They had PhDs. They had models. The models assumed housing prices couldn't fall nationally at the same time. They were wrong. When your sophisticated model is also the model determining your own valuation, your own leverage capacity, and your own reported returns, the sophistication starts to look a lot like a very elegant conflict of interest. Either way, the international comparison is coming, and you're not going to love it. In 2012, China's shadow banking sector looked like this: massive, fast-growing, offering yields higher than regulated banks, minimal disclosure requirements, deeply embedded in real estate and infrastructure lending. Ordinary Chinese citizens poured savings into wealth management products linked to this debt, attracted by the returns. Regulators issued reports, very comprehensive reports. In 2021, Evergrande collapsed under $300 billion in liabilities. The contagion spread through China's entire property sector. Families who'd bought apartments with down payments lost their deposits when construction halted. Investors in wealth management products linked to property debt took losses that were in many cases total. Now, to be fair, the U.S. private credit market is not Evergrande Evergrande. The legal structures are different. The regulatory backstops, imperfect as they are, exist. The US doesn't have the same state-directed lending dynamics, but the core mechanism is identical. Yield-chasing capital flowing into opaque debt structures with self-reported valuations, embedded in a financial system that is now too dependent on it to regulate it easily. Remember when I said the regulators have been writing reports? The IMF's 2023 Global Financial Stability Report recommended mandatory disclosure standards, standardized valuation methodologies, and systemic risk monitoring for private credit. The Financial Stability Board issued similar guidance. The Bank of England flagged liquidity mismatch in BDC structures specifically. The SEC has had open comment periods on BDC disclosure reform since 2022. As of 2025, voluntary guidelines, adopted by some firms, when they feel like it. Remember the water pressure metaphor from earlier? Tighten the regulated pipe, the water moves to the unregulated one. What I didn't say at the time is this: sometimes the new pipe is bigger than the old one, and sometimes it runs directly through your retirement account. So where does that leave us? Let's be honest about it. There are essentially two paths from here, and neither one is clean. Path A: regulators move slowly. The market keeps growing at its current 15 to 20% annual clip. At that rate, it crosses $3 trillion globally within 5 years. At some point, a recession, a rate shock, a major default chain, there's a disorderly unwind. Pension funds take losses on assets they couldn't price going in and can't exit going out. Mid-market businesses lose access to capital. The government faces overwhelming political pressure to backstop an industry that was explicitly built to be the alternative to government backstopped lending. They probably do it. The firms who built private credit walk away fine. Path B: regulators move now. Mandatory disclosure, standardized valuation requirements, leverage limits. The market contracts sharply as capital reprices risk it couldn't see before. Pension funds take losses on the markdown. Mid-market businesses face a temporary credit gap while the banking system slowly expands to fill it. It's a controlled bleed rather than a sudden crash. Still hurts, still hits the same people. In both paths, the people who designed the post-2008 regulatory system built specifically to protect ordinary Americans from opaque, leveraged, unaccountable financial risk will have succeeded completely in making banks safer, and in doing so, created the perfect conditions for the next crisis to occur somewhere they don't have jurisdiction. The fix created the problem. That's not irony. That's how systems work. The $500 billion in the title of this video, that was the US market estimate from 2021. The current global figure, per the IMF's most recent stability report, is $1.7 trillion. The title was already wrong before I uploaded it. The reports are keeping up. The regulation isn't. Every financial crisis produces regulation. Every regulation produces a gap. Every gap produces the next crisis. We have been in this loop since at least 1929. Private credit is not the end of that loop. It is just where we currently are in it. And the people closest to the levers, the ones setting the valuations, writing the covenants, collecting the fees on both sides, will be fine either way. If you want to understand how we got here, how the 2008 bailouts actually worked, and who they were really designed to protect, that video is right here. And don't forget to like and subscribe to keep on learning how money works.